Hey everyone, it's Justin from Number Crunch Nerds. In this video, I am going to perform financial statement analysis on Calibre Mining Corporation, focusing particularly on the 20F annual report for the year 2022. The annual report is called the 20F because this is a foreign issuer. This is a Canadian mining company. That's why it's not called the 10K. I did take a look at the Q1 report for this company, but I didn't see a lot of action in there. Everything was pretty status quo. The real action is in the annual report for 2022. So that is what we are going to focus on. Disclaimer, this video is an exercise in performing financial statement analysis. This video is not a solicitation to buy, sell, or trade any security. All right, with that said, let's talk about the agenda for today's video. We're going to start with fair valuing the Fiore gold acquisition. Then we're going to talk about what are exploration and evaluation assets. Then we're going to talk about In-Situ valuing of mineral properties. Next up will be the company's MPE impairment analysis. Then, of course, we will go through the financials and look for any big ticket items like we always do. Then we will talk about the provision for mine restoration. This video is all about mining. If you want to invest in the miners, if you want to know about the miners, we're going to talk a lot about things related to mining companies. And finally, we're going to talk about deferred taxes. And I know that deferred taxes are usually just there to confuse the living daylights out of everybody, but I'm going to have a special guest who wants to talk about deferred taxes, in particular deferred tax liabilities. And when you see who this is and what this person has to say about deferred tax liabilities, I think you are going to like it. And you will never look at deferred tax liabilities the same way again. So make sure to stick around for that. If you enjoy this video, please don't hesitate to like and subscribe. And let me know in the comments if you would like to see me perform financial statement analysis on any other company. Just throw the name of the company in the comments. All right. Let's jump in. We're going to start with the fair valuing of the Fiore gold acquisition right here. Okay, if you open the 20F, the first thing you're going to encounter is a key audit matter. Now, I want you to understand what a key audit matter is. A key audit matter does not mean that there's anything wrong. It means that something occurred that was significant enough relative to the financial statements taken as a whole that the auditor wanted to call it out specifically so that financial statement users would make sure to see it. This company, by the way, Calibre, is audited. Let's go over here real quick. This is audited by PwC, which is by many measures the largest accounting firm in the world. And I want you to see that it says in their opinion, the accompanying consolidated financial statements present fairly in all material respects the financial position of Calibre Mining and its subsidiaries at December 31st, 2022. And they highlight down here the key audit matters. A key audit matter are those matters that, in our professional judgment, were the most had the most significance in our audit. So basically, it's the big ticket items. Like I always say, we're looking for the big ticket items, and so is PwC. They want to hone in on the big ticket items as well. And I call them a big ticket item. They call them a key audit matter. So that's the first thing you're going to see. And the first one is, what is the fair value of the mineral interests and the exploration and evaluation assets acquired as part of the acquisition of Fiore Gold Limited? So what is going on here? Well, they acquired Fiore Gold. And what does that mean? Well, it means they acquired like a bunch of mines, right? And what is a mine? Well, it's like a piece of land. And inside that land is supposed to be gold. And there can also be physical assets and other things that come along with figuring out if there's like surveys and all kinds of stuff. They can figure out, like, is there gold in this land, right? That's what they're trying to place a value on. They bought all this stuff, and now they have to place a value on it. And that's what PwC is focused on. How did the company's management determine the fair value of this stuff that they bought, these mines that they bought from Fiore Gold? That's the question. That is the key audit matter. And it says right here that they placed a value of $74.5 million. That is what was determined to be related to the fair values of the mineral interests and the exploration and evaluation assets that were acquired from Fiore Gold. They bought these mines and they said $74.5 million of the acquisition price relates to the value of mineral interests and exploration and evaluation assets. So let's go over here real quick and make sure we know where the 74.5 is coming from. This is the detail for the mineral interests and the plant and equipment items that are in the financial statements. Here's a column specifically for mineral interests. Here's one for plant and equipment. And here's one for the exploration and evaluation assets. It's actually these two that are in question, the 26.0 million right here, which I'm going to put there, plus the 48.5 million, which I'm going to put right here. The total of that is 74.5, and that's what they're talking about right here. So it's these items right here. It's these two. The assets acquired during the year, this relates to Fiore Gold. They acquired these mineral interests and these exploration and evaluation assets right here, and they placed a value on them. And we need to figure out what in the world they were looking at in order to place this value on them. That is what PwC wants to know. Now, we need to know what is an exploration and evaluation asset. That is something you need to know if you are interested in mining companies. Here's the great definition, and I went right to the IFRS literature. IFRS is the International Financial Reporting Standard, which is what Canadian issuers use, and this is a Canadian company. This is the accounting standard that they use. It says, an exploration and evaluation asset shall no longer be classified as such when the technical feasibility and commercial viability of extracting a mineral resource are demonstrable. So basically it means before you can actually prove that these reserves, like gold reserves or any mineral, it doesn't have to be gold, but in this case we're talking about gold, until you can prove that these gold reserves are not only there, but you have the technological feasibility and it's commercially viable to actually extract them out of the ground. See, there's kind of two parts. It's not only that they're there, not only that the gold is there, but can you get it out of the ground or out of the mountain or out of wherever it is in a feasible and viable way? If you can't, there can be all the gold in the world in that mountain, but if you can't actually extract it, then it doesn't really have any value, does it? So until you can prove the technological feasibility and commercial viability of actually getting these minerals out of the ground and into the marketplace, everything prior to that is going to be classified as simply an exploration and evaluation asset. You're not actually at the production stage yet. This is pre-production stuff. So $74.5 million of this price is related to pre-production stuff, okay? And PwC wants to understand how in the world did they place a value on that, okay? Now, it says right here, management applied significant judgment in estimating the fair values of these mineral interests and exploration and evaluation assets. Management used discounted cash flow models and in-situ values. What in the world is that? We're going to talk about that in a second. Key assumptions that they made included things like future metal prices, production based on current estimates of mineral reserves and recoverable mineral resources and future operating costs and all this stuff, including in-situ multiples. So there's all these assumptions, right? It's not just it's not like you can just look at a piece of land and say that's worth $74.5 million. You have to go through all of these things, all of these assumptions, and you have to bring in experts to figure out what's going on. So what is an in-situ multiple? By the way, before we go on to what in-situ multiples are, if you know anything about Calibre, you might be saying, wait a second, why is so much of this classified as exploration and evaluation? I thought they had a mine in the Fiore group, the Pan mine, that's producing. Well, let's go over here real quick. Here's a detail. So we're going to go on a little treasure hunt here. That's kind of what gold mining is, a little treasure hunt. We're going to go to this detail. Here's the 48.5 right here. See the 48.5? That's this number, 48.5. This is the breakout right here. This is the detail of what is included in this 48.5 and what specifically what mine it relates to? Well, they actually bought a couple of different mines. It wasn't just one. The Pan mine, only 2 million of the exploration and evaluation assets actually relates to that one, because that one, based on my understanding, this one does actually produce gold currently. Like, this is a producing mine right here. Most of the exploration and evaluation assets are actually related to these two, the Gold Rock and the Golden Eagle, and a little bit related to this other one down here. But most of it are these two right here. Now, without knowing anything about these two mining properties, the Gold Rock and the Golden Eagle, I feel highly confident saying that because so much here is classified as a exploration and evaluation asset, that these two mines are pre-production. They're either not producing at all, or they're just barely getting started producing. Okay? Because if they were producing, if it was proven, right, that these resources are not only there, but they're extractable in a reasonable and viable way, then these assets wouldn't be classified as exploration and evaluation anymore. They'd be more like property, plant, and equipment, for example. Okay, so I did discover that Fiore Gold has a website, fioregold.com. If you're interested in this company, you can certainly go check it out right here. I see that there's a link here. These are all links on the website. They have one for each mine. Here's the Pan mine. Here's the Gold Rock mine. Here's the Golden Eagle mine. Here's that other mine that only has a little bit associated with it. And you can see, kind of based on their descriptions, they call this one the cash engine. Well, I would imagine that if they call this one the cash engine, it's probably a producing mine, which is kind of in line with what we said right here. This one is the growth engine, the Gold Rock. They're calling that the growth engine, and it says federal permits received. Well, if the stage we're at is federal permits received, I have a feeling they're not producing much of anything yet. Maybe they're not producing anything at all. I'm sure you can go dig into this link and see if that's true or not. But I'm guessing based on this classification, at least as of this balance sheet date, remember, we're talking about the last day of 2022. We are 7 months beyond this filing, okay, as far as like the date that these numbers relate to. So it's possible they've started mining in the Gold Rock and the Golden Eagle properties as of today, as of the making of this video. But as of the balance sheet date that we're analyzing, it looks like chances are these hadn't started. And then, of course, the Golden Eagle, it says 2 million ounce indicated resource. As soon as I see the word indicated resource, I'm thinking that probably hasn't started, at least as of this balance sheet date. Okay? But if you're interested, you can go check it out there, fioregold.com. So let's now go back and see what in the world is an in-situ value and an in-situ multiple. So let's go right here, and I'm going to show you a picture. Here is a mountain, okay? How much gold is in this mountain? Say what? Tell me how much gold is inside this mountain right here. I haven't started digging yet. I haven't brought in the backhoes yet. There's the miners. They're not here. The miners are not here. They're all at the bar. The miners are all at the bar getting drunk. Nobody's here yet. Tell me how much gold is inside this mountain. Well, how are you supposed to do that? How are you supposed to know how much gold is inside this mountain or any mine or any mining property? Well, what you have to do is you have to bring in experts, these experts who make a career out of determining this. They use all kinds of technology and mathematical models, and they drill boreholes, and they try to figure out, based on samples, how much gold is in here, and they have machines that, X-rays is the wrong word, but something equivalent to like, surveying the ground and trying to figure out how much gold is in here. And there's people who have, they make full careers out of doing that. And here are the basic levels at which they can predict how much gold or any mineral is inside of a property, right? They have kind of 3 levels. They have what they refer to as like measured or proved reserves of these minerals, right? This is kind of like the first line of defense here. Like, this is like the stuff you can really know for sure. It's proven. It's measurable. And then after that, based on all of their professional experience and extrapolation models and technology and so forth, you get to the next level, and this is like kind of like probable reserves. Like we can prove there's so much gold in there, and based on all that, it's kind of probable that there's more gold, and also that it's feasible to extract it. That's kind of like what they call the indicated level. And then the last level here is the inferred level. And this level up here, I'm going to say is kind of like your crystal ball action up here. Okay, I mean, these guys are professionals and they do this for a living and they understand what's going on. I get all that. But I mean, you're still trying to figure out how much gold is inside this mountain before, anybody's really done anything. And not only how much is in there, but how much can you realistically extract in a commercially viable way. So, there's at the third tier of this, you got a little crystal ball action going on there. So when you add these three up, this is what's called like reported as in-situ mineralization estimates. These are an estimate, like they're making an estimate. The first level is like really high probability because they can measure it. Second level, a little bit less. Third level, little crystal ball action. So what PwC has to do is they have to look at these experts and all of the stuff they did, all the things they performed and everything management decided and their estimates and their assumptions and et cetera. And is it appropriate that this number, this value is 74.5 million? Now, for my purposes right here, showing you all of this, I'm not here to say that this number is right or wrong or good or bad. That's the job of company's management, and that's the job of PwC to audit that number and agree that they think management's estimates are reasonable. Our job here as analysts is to say, do we understand what this number is? Do we understand? And yeah, we understand. It is, you acquired a bunch of mines, some of which are not producing anything yet, and based on a whole bunch of estimates and assumptions and so forth, and expert opinions and some technological measures and mathematical models, we came up with this number. And that is what this number is. And that's one of the biggest numbers on, it's a component of one of the biggest numbers on this company's financial statement. So when you're analyzing it, you want to know what that is. So we covered that. We covered the in-situ measurements. Now let's go to the MPE impairment analysis. This is key audit matter number 2. All right. And it says that the net book value of the MPE is the mineral interests and the plant and equipment. And I want to go over here to this is the same detailed balance sheet as we saw before. And we were talking about these two numbers right here. Remember, we were talking about the 26 and we were talking about the 48. Just these two. That's what the first audit matter was about. Now they're saying, what about this entire column? The book value all the way to the bottom after some depreciation has been accounted for, not only on the Fiore acquisition, but on all the mineral interests that are owned by Calibre, which include those from the Fiore acquisition, as well as some from, they have a lot of mines down in Central America, in Nicaragua. So they have mineral interests there. They have mineral interests in Washington, I believe. And as well as all the property, plant, and equipment. So we're looking at the entire column now. Because if you look right here, this $477 million, this is the total property, plant, and equipment on the balance sheet, on the face of the financial statements. This number is your big ticket item as far as assets goes. Okay, so that's what PwC is focused on. And so now they're saying, okay, is this really a realistic book value? Is this really a realistic book value for all of this? And management has to perform what's called an impairment test to see if there are any impairment indicators. And what would that mean if it's impaired? It would mean, well, you're saying, by the way, here's the 209, here's the 126, 209, 126, that's the 335.9. That's your 336 million that they're talking about, okay? That's where that number comes from. They're saying, when you look at your ability to extract all this gold out of the ground and to sell it in the market and so forth, and the price of metals and future interest rates and all this different stuff, are these assets really worth this much, or do they have to be impaired? Impaired would mean you have to write down the value. Like, no, it's really not worth this much. When you consider the future sales and the costs to extract and all this kind of stuff, these assets are really not worth that much. You're going to have to impair them. That is the analysis that management must go through. And they used discounted cash flow models and all kinds of stuff. Discounted cash flow model is just to evaluate the value of money received in the future, because based on the time value of money, that a dollar today is worth more than a dollar later. So they use all that stuff. And here's the answer. As of December 31st, 2022, and of course the previous year, the company did not identify any indicators of impairment. So that's a good thing, right? You don't want your assets to be impaired. That's a positive thing, right? This company is saying, yeah, our assets are, these two in particular, are worth $335 million because based on our future ability to exploit this asset and generate revenue and profit, it's still worth this much. It has not been impaired. And PwC reviewed that, audited that, and agreed. And so that's a positive thing. But that was the second key audit matter that PwC wanted to bring to the attention of financial statement users. All right, so now we're done with that. Let's go to the financial statements themselves and see if we can dig up anything else. There's a few items I want to talk about. Let's start here with the statement of cash flows. If you look here, net cash provided by operating activities. This company is cash flow positive from operations. It produced $96 million of cash flow from operating in 2022. It produced even more than that in 2021. And it looks like it's reinvesting a substantial amount of that into expenditures on its mineral properties and other plant and equipment. And I think the key takeaway is, based on the cash flow statement, there's three sections, right? There's the money that comes from your operating business. There's money down here that can come from financing, which basically means borrowing money. And then there's what you do with it, like the investing activities right here, okay? This company, Calibre, is really not borrowing too much. There's not a lot of borrowing going on down here. This particular 13, which is new to 2022, I read relates to some kind of specific assets in one of the Nicaragua mines. Who cares? That's kind of like immaterial. I wouldn't even bother with this. It's a small number relative to what's going on up here. I think the key takeaway is this company's really not borrowing money as far as these financial statements are showing. What they are doing is they're producing cash out of operations and they're reinvesting it in the business. And I can certainly see the argument that by any textbook example of what a business should be doing, generating cash out of your operations and plowing it back into your business through investment, I can certainly see the argument that that is what you would want to see a company doing, and not borrowing significant amounts of money in the process. So I would argue that certainly seems like it's going in the right direction for this business. Now let's go to the statement of financial position, which is just another phrase for balance sheet. Let's highlight the big ticket items here. You have the mineral interests for the 477,180. This is what we covered in the first part of this video. This is what PwC was focused on. So we're done with that. Right here, I did notice that the accounts payable and accruals has doubled from the previous year. However, and you might wonder, like, why are the accounts payable? Why is your accounts payable not being paid? You know what I mean? Like, why has it doubled? That is a question. If I was, if I wanted to get the CFO on the horn and say, hey, what's up with this? I would certainly ask about this number. There's no footnote provided for this. These numbers here are the footnote item that relate to this, give you more detail. This one doesn't have a footnote, so unfortunately, there's no more information I can give you on why this one doubled. So we'll leave that one alone, just something that to be aware of as a financial statement user. We're going to go down here to the non-current liabilities, and these are the last two things we're going to talk about. The provisions, we're going to get to that in a minute, $74 million, and deferred tax liability, $63 million. I'm going to come back and talk about these two. That's the last two tabs we got right here. Before we go, let's cover one more thing right here on the equity statement. This is the equity statement. You can see that over the last 2-year period, there really hasn't been too much issued in the way of common shares. You got a little bit here for options and warrants and some performance units, and this is kind of sounds like employee-related stuff. It's pretty small. Same thing here. The only item that is on the list here is this 101 million shares, and that relates to the Fiore gold acquisition. And that's the only item, really, other than these small items that increased the shares outstanding in the last 2 years. And so there's 2 points to make. One is, as in many Canadian companies, the authorized shares, for whatever reason, are always unlimited. There's actually like no number for you to reference and say, well, this is the maximum that they could issue before there has to be some kind of like shareholder vote to increase the authorized shares. These companies have unlimited shares, so theoretically they can issue shares, without shareholder approval to whatever extent they want. So the only thing you can do as an analyst is to look at basically management's historical behavior and decide for yourself, like, well, are they being responsible with the share structure? I mean, at least in the last 2 years, I didn't go back further than this, but at least in these 2 years, it certainly seems like they're being responsible. I mean, there's only these minor increases related to employee stuff. And this is specific to this acquisition. In fact, if you look down here, the total purchase price, this is the Fiore acquisition footnote right here. It says the total purchase price was $118 million, of which $107 million value anyway, $107 million value, which related to 101 million actual shares, was paid for the Fiore mines, and only $8 million was paid in cash. This is the value. The only $8 million is cash. The rest is stock. And so I could see the argument. If somebody made the argument to me that some seller had a property worth $118 million, and they accepted only $8 million in cash and were willing to accept $107 million worth of Calibre stock. And so if somebody made the argument to me that that shows confidence, on at least on the part of the seller in Calibre, I mean, I could certainly see that a reasonableness to that argument. That doesn't make it a guarantee, obviously. Many companies have exchanged property or sold property for shares of another business, and then that other business went nowhere, and they got burned in the end. So that doesn't make it a guarantee just because this particular seller decided to accept common stock. But, it is a point of consideration. Like, well, this seller of $118 million in assets took almost entirely stock and was willing to accept that in lieu of cash from Calibre. So, it's a point to consider when you're reviewing the company's financial statements as a whole. So that covers the financial statements. The only thing the last two things I want to cover are just this one. These are the big ticket items in their liabilities. You have these provisions, which we're going to cover next. And then finally, our deferred taxes with our special guest, who's going to tell you something quite interesting about this liability right here. So let's go to the mine restoration. So here we are. Look at this picture right here. So this is a mine, and when you're done mining, and this is not just Calibre, this is any mining company, right? When you're in the business of mining, you have to dig up the ground, right? You have to basically destroy the ground. There's a lot of different kinds of mining. There's pit mining, which is what this appears to be. There's strip mining, where you strip off layers of the land like this. There's a lot of different kinds of mining. But the long and short of it is that you basically destroy the land in order to extract the minerals, right? And so what happens is the governments that are over the jurisdictions of wherever these mines are, they're like, wait a minute, you can't just like come in here and like create this big hole in the land, and then when you're done mining, just take off to Tahiti or whatever, and that's the end of it. Like you can't just leave this here like this. You got to do something about this. I mean, let's be honest. Like, what does this look like? Well, it looks like the Almighty Sarlacc. You guys remember the Almighty Sarlacc from Return of the Jedi? I might be dating myself there, but I mean, you got to admit, like, the resemblance is uncanny. You know, you got Luke, you got Han, you got Chewie, you got the almighty Sarlacc. The government is like, we don't want the almighty Sarlacc just like sitting here forever in the middle of the land. Like, you got to clean this up. Okay, well, clean it up how? Well, like, fill the hole up with dirt. You know, you got to fill this up with dirt. You got to grade the land so we don't have problems with flooding. You got to plant like trees and shrubs. Like, make it look like this over here. Make it look like you weren't here doing this in the first place. And okay, but like, there's a cost to doing that. I mean, this is like a really big hole. I mean, you need to be hauling dirt in here for weeks or months to fill this up. And then you got to grade the land. You got all kinds of things to do. And there's a cost to doing that. There's a cost to cleaning this up, right? And that cost is called the mine restoration provision, right? And that's not unique to Calibre. That would be any company with a producing mine is going to have a mine restoration provision. And a provision is just a liability to pay for something later, basically, right? So they have a $61 million provision for mine restoration because they're responsible for cleaning this up. And not just this one, all of them, right? This is the sum of all of the mines for which they have a provision for. And again, this applies to any company. It's not just Calibre. You know, so the point of this is it's not that this is good or bad. It's understanding what this is and understanding in the context of like the hierarchy of liabilities. Like, liabilities are not all created equal. There's kind of like really bad liabilities, and then there's liabilities that are just part of the normal course of business. Like, this liability, somebody says to you, well, they have a $60 million liability. Well, yeah, but that's just part of the normal course of business. Like, this company is in the business of like ripping up the ground to get the minerals out. So part of that is filling it back up and cleaning it up when they're done. And so this is just normal. Like, in the normal course of business on every mining company, you would see this. As opposed to, for example, convertible debt. Like, convertible debt is debt that can just like dilute the living daylights out of shareholders. You know, that's a general statement. This company doesn't have any convertible debt that I saw. But in the hierarchy of like good liabilities versus bad liabilities, a bad liability would be something like convertible debt. Whereas this, I'm not saying it's good, so to speak, but it's better. Like, it's a better liability. It makes sense when you understand what this is for and understand that this is just in the normal course of business for this company. So that's what this liability is, this $60 million. If we go back here real quick, the two big ones, that's what this one is. It is the provision to clean up the mess, so to speak, clean up the mine sites when the project is over. And that could be years or even decades away, by the way. I mean, these mining projects can go on for decades. But the liability to clean it up stays on the books until the cleanup is complete. All right, the last item we're going to talk about is the deferred tax, and we're going to reveal the special guest in a minute who is behind this gray square. But before we do, I want you to understand a deferred tax liability example, a real simple example. Let's run through it. Deferred taxes are a timing difference between when you do something for your financial books and when you do it for your tax purposes, like actually dealing with the taxing authority. Okay, so let's just take a real simple example. Company has revenue of $1,000. That's the same for book and tax. They have depreciation under a book method of 100, but under a tax method, they have 500. Tax is usually accelerated, meaning there's more, right? So depreciation is 100 for book, 500 for tax, resulting in income of 900 for book, but only 500 for tax. Let's just assume the tax rate is 40%. That means on your books, on your financial statements, you're going to record $360 of tax expense. But under the tax law, you actually only have to pay $200 now. The rest is deferred. The rest of this $160 is deferred until some future time. You record $360 of income tax expense in your books now, but the tax law only required you to pay $200 cash out the door now, So you have 160 liability to pay later, but time value of money perspective, you didn't have to pay the 160 now. All right, so time to reveal the special guest, and that special guest is Warren Buffett. Warren Buffett says, look at this, Berkshire Hathaway has a massive $63.2 billion deferred tax liability that Warren Buffett has equated to an interest-free loan from the U.S. government, right? It's an interest-free loan from the government. That's what we just tried to prove right here. If I actually have $360 of tax expense that I have to pay at some point, but the U.S. government, the taxing authority, says, you know what? You could just pay $200 now, and you can pay the rest later at some other time based on the tax law, which is what caused this number to be bigger than this number. That's like a loan. That's like a $160 loan that there's no interest on that, right? Deferred tax liabilities bear no interest. They give us the benefit of debt, but none of the drawbacks. So if you don't want to take it from me, take it from Warren Buffett. He loves deferred tax liabilities. He's all about them. They're a interest-free loan from the government. So again, when we're talking about like the quality of liabilities or the hierarchy of liabilities, right? And you see something like a deferred tax liability sitting here, you got to remember, like, well, Warren Buffett would say that that's like an interest-free loan from the government. Yeah, you have to pay it. It is a real liability. You do have to pay that eventually. But you can sit on that money and use it for your purposes interest-free. Certainly that sounds better than what? Like convertible debt, for example, where you're borrowing money probably at a really high interest rate, whereas this interest rate is nothing. And also the convertible debt has other features that, could be detrimental to shareholders under, it just depends on the facts and circumstances of the situation. That's a generalized statement, but you see the point that in the hierarchy of like what kind of debt do you want or liabilities do you want to see versus what you don't want to see, I could certainly see the argument that like a provision for mining cleanup, which is occurring in the normal course of business, and a deferred tax liability, which Warren Buffett would say is an interest-free loan from the government, I would much rather see a liability like that than something like convertible debt, for example. Okay, so that is the analysis today on Calibre Mine Corporation. And if you enjoyed this video, don't hesitate to like and subscribe and put a comment below about any other corporations or companies that you would like me to perform financial statement analysis on. And I will see you in the next video.